Good afternoon, all. I am Tanya Garwal, and I have the pleasure of being your moderator for today's event. It is my great honor to welcome each and every one of you at the webinar, where we have gathered to discuss the key considerations in international taxation members matters for members in industry. I also would like to thank you, the committee, for members in industry and business, for organizing such an insightful webinar and wish to give a brief introduction regarding the objective and a slight brief regarding the working model of the committee. So, its primary purpose is to support IC members, working industry, business, and other non practice environments, and it provides supports like to organize job placement programs, workshops, and training programs, to provide research papers, report on best practices, etc. So, without further ado, let's dive right into it. I would like to introduce our today's speaker, Nishant Gupta. He is a chartered accountant and placed in all India merit list at both final and intermediate level. He is also a graduate in law and graduate in commerce from SRCC Sri Ram College of Commerce. Nishant is currently working as director with PwC and is based in New Delhi, India. Nishant has more than 10 years of working experience in dealing with corporate and international tax issues for medium and large size multinational corporations. He is a regular speaker at various professional forums or events organized by industry bodies. Hence, please join me in giving Nishant a warm welcome and would like to hand over the floor to Nishant for taking a session ahead. Thank you.
Thank you so much, Tanya, and thank you to the entire ICI team for giving me this opportunity. So, the topic we are going to discuss today is around key considerations on international taxation when it comes for members in industry and practice. So, so quite a wide topic, lot of nuances involved. We'll try to discuss as much relevant topics as possible from my side. Would suggest if we can keep this as interactive as possible. Please feel free to raise hands or ask your questions in the chat box. I'm not sure if this real-time chatting is allowed. Please feel free to add your comments here.
You can ask
And
questions in the chat box, which we can take at
sure,
the end.
sure. So to start off our discussion, while I have prepared a brief presentation, um, we all know the importance of taxation in our business worlds. Fortunately or unfortunately, every businessman is required to contribute on the taxation, and this becomes very vexed when it comes to cross-border scenarios. Uh, Needless to say, every government, every country looks out for opportunities to extract as much taxes as possible for the development of their respective nations, and that's where the issue comes around which country should get how much share of taxation. And so it becomes important for a businessman to understand the implications and nuances in that particular country, so that he is well prepared and considerate of respective tax implications in each country. So let's start with it. I am just sharing my screen to share my presentation with you guys. Yeah, I hope my screen is visible.
Yes, Nishant, it's visible.
Thank you. Thank you, Daniel. So, briefly, just to initiate the context, we can see the importance of taxation. The big names of the world, whether Google, Amazon, Starbucks, they all have faced the bad names on account of any sort of taxation, on account of any sort of taxation implication, any avoidance controversies. And I can tell you, it has really impacted a lot their public image, and all these companies have faced huge backlash whenever they were alleged of implicating any structure which was leading to tax avoidance or tax plannings. So that's where the relevance of tax international tax business comes very important. So starting with it, few international business models of any group which is wishing to expand its presence beyond its geography. So typically, entities in multinationals and group structure, they can be either manufacturer or distributor or service provider or a combination of either of these three. And there are different kinds of business models even within these sort of bifurcation. For example, if a company in USA wishes to set up its manufacturing in India, so it has a lot of questions to ask. For example, whether it wants to be a set up a full-fledged manufacturing in India, or just a licensed manufacturing or contract manufacturing. So all these are different. These have different functional and risk profiles, and these all have the great implication on the taxation, on the incidence of tax that these groups will face in that country. Similarly, when we go to distributor, again, you can have a case of normal distributor who is buying and then selling on a P2P basis, sharing all risk and rewards on his own name. Then we have a limited risk distributor, then just a agent, or we call it commissioner, or lastly, just a marketing support company who is just providing information, not involved in actual sales. Then another way of doing international business is by having a service provider, where you have a entity in India providing you various kind of services. In those cases, service provider charges fees for those services. Usually, it can be on a cost plus basis, actual time spent basis, or on a market standards. Again, important aspect is when it comes to companies which have a research and development centers. So you can have a contract R&D businesses or full-fledged R&D businesses. So just to this in this slide, just wanted to cover and give a brief overview how the multinational businesses often expand across various locations and segregate their functions. And these are all driven by commercials, lot of commercial. To give you an example, usually in India we have seen lot of interest on global captive centers, GCCs. We all know that a lot of big multinationals have already and are also starting their GCCs in India. So this is driven by many factors. One of them being availability of skilled workforce at a competitive prices. So usually a company which is a company like let's say American Express Bank. It's an American bank having, while it's have a full-fledged operations in India. That's one way. Apart from this, it also is having a service providing entity, which is its GCC, which functions as a captive unit at a back office for other global countries in India. So different companies can, based on commercial considerations, they design the business model, and with those commercial considerations, we analyze what sort of their functional assets and risk classification is, and based on that, their taxation is determined. And so here, like we discussed, important parameters of how much tax should be attributed to a country is based on certain key trends or approaches. One of them is nexus. What sort of linkage is, or what is the nexus of that country with your overall operations? Similarly, characterization. What sort of functions are you actually performing? And then again, data. In today's scenario, data is very important, and with the growing relevance of data in the overall business is even leading to a shifting of the profit base towards the data. So the country or the location contributing more towards data tends to take the higher share of the profits. So these are the key new trends, and needless to say, they all are linked to three key functions, which have always been at the forefront of international taxation, and always been highlighted by our OECD, whether in BEPS or in Pillar One, Pillar Two, that is coherence, substance, and transparency. So you have to take care of the coherence with which these functions are interacting, and where lies actual substance, which jurisdiction on a substance basis is actually contributing to the overall profits of the headquarters. So these was so with this broad context, uh, let's discuss something about the law, how our law, what is how the scheme of our law runs, and where the government gets power of how to tax, what to tax. So, very basic sections of our Domestic Income Tax Act, this slide talks about, that is section 5, 6, and 9. So, we all know section 6 talks about residency of any person in India. So, it first, based on section 6, we determine whether a particular taxpayer is a resident or not. Here, an important aspect is a place of effective management, which is relevant in the context of company. So again, this is a funda which tries to attract even foreign companies within the ambit of residency for Indian tax purpose. And the guiding principle of place of effective management, or POEM we usually call it, the guiding principle is that it says leave apart actual place of registration, leave apart leave apart where the directors are based out, leave apart where the employees are based. It says focus on the place where key management and commercial decisions are taken. So the place where those decisions are actually taken, that in substance, that makes the residency country of residence of that company. So once we decide on the residence of any taxpayer, based on that residence, we arrive at the scope of total income. That is how much income is taxable. So if you are a resident, then your global income becomes taxable in India. So whether you have earned from India or outside India, so it will be taxed entirely taxed in India. Whereas for non-resident, only income which is accruing or arising in India, that will be taxed. Then section 9 talks about certain cases where a deeming fiction has been brought out. Based on that deeming fiction, certain incomes are deemed that they are accruing or arising in India. So whether if you are a non-resident, then and you fit into the deeming fiction, then you are liable to pay tax on that particular income. So certain key provisions of that deeming fiction are business connection, and a very interesting provision of significant economic presence, or we call it SEP. Then transfer of any capital asset which is situated in India. Then indirect transfer, again a very interesting development of the Indian tax laws. And again, very common transactions of royalty or FTS. So, brief scheme of how the Indian Domestic Act is worded. All this takes us to two very important concepts of international taxation, and which are the pillars of how we actually tax and play with all that nexus approach, coherence approach, and ultimately offer income to tax. Those are tax treaty and the transfer pricing principles. So, in the next few minutes, I will like to discuss both these concepts in a fair detail, so that to give you a broad idea of how they impact our business transactions. And also, also another important principle is on double taxation. So, like we discussed, let's assume in case of a resident, its entire income is taxed in India. Similarly, in case of non-residents, income which is arising or accruing in India is only taxed. So let's take a case of a US company, which is a resident of USA, but it is earning income which is accruing in India. So source is India. So in this example, state A is USA and state B is India. And there is from state A, some people are going to India. They are carrying on business activity and earning income from India. So as per Indian domestic laws, that is state B, the income of state A from these activities will be taxed in India. Similarly, as per, let's assume, which should be most likely the case, similarly in state of residence, that is USA, because they are resident, going by residence rule, entire global income will be taxed in USA. So that particular income which US is earning from India will be taxed in both the states. As a businessman, this will be a huge loss. So for this, both the countries agree into a double taxation avoidance agreement, where they either agree that okay, one of us will only tax this, or if one of us can't, both of them want to tax, then one of us will allow the credit of taxes paid in the other country. So ultimately, the objective is to avoid the double taxation, so that only one of the country taxes the ultimate income. Similarly, on transfer pricing, so as we all know, to give you a brief idea, transfer pricing is a concept which came somewhere around early 2000. It refers to pricing of transactions between associated enterprises, or we call usually related party transactions, which are international cross-border transactions. So if you are entering into related party transaction and on the cross-border scenario, that is subjected to transfer pricing. And in this case, objective is to ascertain what is the arm's length price of the transaction that two parties have entered, and then comparing that with the actual transaction price between the parties. If there is any deviation, then the due adjustments are made. So this is the broad funda of transfer pricing. We will discuss about this in detail in the later section of our discussion. But yes, this in itself is a very detailed analysis, based on lot of market factors, lot of industry factors, lot of comparability analysis. So broadly, this is another pillar of international taxation that we will like to discuss. So moving ahead on on the basics of double taxation avoidance agreement or tax treaty. So let us first understand a brief about the treaty making process in India. So usually international tax treaties are an executive act. Then a treaty is concluded with the approval of the Union Cabinet. So usually it is all started by the Ministry of External Affairs, and in consultation with lot of other ministries, especially Ministry of Commerce Affairs and Ministry of Finance. So these ministries together, they initiate the consultation discussion between two countries. There is lot of negotiation deliberations between the two countries on the draft, and then they take care of the principles of underlying model convention, whether it is OECD or United Model. Based on that, once both the countries arrive at a consensus, then in India, the cabinet of MEA, Ministry of External Affairs, they note their approval, and once that is done, the ministers have signed the treaty. Then it is laid before the houses of parliament. Then it is laid before the cabinet. My apologies, for approval. So this is the broad structure of how the treaty making process runs when it comes from India side. Few fundamental concepts for tax treaty are: one, it is a bilaterally negotiated agreement between two countries. Objective is to avoid double taxation, and obviously with avoidance of double taxation there will be development of economic relations and trade between the two countries. Another important aspect is the cooperation in taxation matters. So objective is to exchange of seamless exchange of taxation related information between the countries, so to check if there is any case of tax defaulter or tax evasion in either of the country. It also confers the rights and obligations between the states on account of how much rights they have on the taxation, and obligation on account of tax credits, and they are binding on the contracting states. And usually it has been held time to time by the apex court that these are just like a commercial contracts, and they should be always followed in a good faith, and usually not given too much of the technical interpretation. Rather, they must be proceeded on the basis of good faith and in the spirit of the objective, that is to avoid double taxation and development of economic relations. So we all must be knowing the power to enter into tax treaty and interplay with the domestic tax law comes with which section of the Income Tax Act. So it is our section 90 of the Income Tax Act 1961, which which gives the enabling power to the government to enter into the tax treaty. So, a bird's eye view of the text treaty. So, first are the scoping provisions. So, first is Article 1 and 2. So, these are the base article which laid down the scope the treaty, on which persons it is applicable, and on what type of taxes do it covers. Usually, it is applicable on persons who are residents, and secondly, the taxes are usually income tax. But yes, in some of the treaties, it is very interesting to know that even they cover indirect taxes also. Germany is one of the example. It covers the trade tax, which earlier we used to call by the name of VAT in India. Sorry. And then another scoping provision comes at the last of the treaty, which are Article 30 and 31. They talk about the date of entry into force, as well as when it comes into effect, the treaty, as well as the termination date, if there is any date of termination. Then next comes definition provisions. Then these are the definition provisions under Article 3 to 5. They lay down Article 3 lays down the general definitions of certain clauses, certain expressions. Article 4 lays down the who is the resident. Again, a very interesting article. Article 5 lays down the definition of permanent establishment. Then Article 23 and 25 talks about double taxation elimination. That is, what if a particular income is taxed in both the states? So Article 23 lays down the method or the formula based on which one country usually allows credit of tax paid in the other country. And Article 25 is on mutual agreement procedure, which is which is a one step further, which says, okay, despite everything, still double taxation is not being avoided. Then why don't both the countries nominees sit together and discuss the case? So in this case, taxpayer approaches the competent authority. In an Indian case, an Indian taxpayer will approach the competent authority of India, lay down the problem statement, and then competent authority of India will discuss with the counterparts in the other countries, say USA, and they will mutually agree, okay, how, in what manner, if this is not getting covered by treaty, then in what manner they can enable the taxpayer to eliminate the double taxation. Then very interesting provisions come on anti-avoidance. So, like we all know, our Indian Income Tax Act has general anti-avoidance rules, which we usually know by the name of GAR. Similarly, in treaty, we already have certain anti-avoidance clauses. One is Article 9 on associated enterprise, which is primarily similar to the principle of transfer pricing we discussed earlier. And then is Article 29, which is on limitation of benefits or principal purpose test. Limitation of benefits is quite a old article in many treaties, but principal purpose test is a very new development. So principal purpose test is a very wide anti-avoidance provision which has been culminated after OECD BEPS 1.0, BEPS 1.0, pursuant to the MLI, multilateral instrument of BEPS. So India has already given India has accepted MAPS and MLI, and for most of its treaties. So PPT by default is there in most of the Indian treaties. And then comes a lot of miscellaneous provisions. I'm not going to discuss those in detail, but first one is important. Article 24 non-discrimination, which usually is based on the principle that a non-resident should not be discriminated against the resident in certain cases, subject to in same situations. And then there are substantive provisions, a long list of articles dealing with respective nature of income. For example, dividend, we have specific Article 10. Then salary, we have Article 15. Then say if we have a business profits, it's Article 10, is 7, etc., etc. So this is a broad view of these tax treaty provisions. So then moving ahead, key articles of tax treaties. So one I want to discuss on permanent establishment. So because permanent establishment is critical for constitution of business, for taxation of business profits. So so unless you have a permanent establishment, taxpayers permanent establishment, or we call it a P in other country, the its business profits are not taxed. The types of PE we usually have are fixed place PE, agency PE, and service PE. So examples of fixed place PE are if a foreign company has any branch office in India or place of management, say they have a warehouse in India or sales office in India, those constitute fixed place PE. Then agency PE, if you have an agent who is dependent on the foreign company and regularly concluding contracts, negotiating contracts on behalf of foreign company, that can constitute agency PE. Then there is a case of service PE where foreign companies send their employees in India for carrying out certain business activities beyond a stipulated time period. So once you have a PE, then your business profits to the extent attributable to the PE are taxed in India. And the calculation of those profits is based on a separate entity concept. You have to assume that PE by itself is a separate entity and calculate its profits accordingly. While it is easier said than done, because usually it is not possible to bifurcate the business activities in numerical terms. There is a lot of coherence and interlinkages between the foreign company and this P. Because please appreciate, P is just a hypothetical person. It is not legal person, not so legally registered anywhere. So so practically no one would have been preparing any tax accounts, any separate balance sheet or P&L of this P, usually, unless the taxpayer itself admits there is a P and it proactively prepares those. Sorry. So it becomes practically very difficult to arrive at this number, that what is the actual income of that P which will be subjected to tax in India. So in the past, we have observed taxpayers as well as tax authorities proceeding with a shortcut where they attribute certain percentages of the global profits to P in India. And then it comes problem, what sort of global profit you need to check, whether it is net profit, it is gross profit, whether it is, and what sort of percentage you need to allocate to India, because there are functions situated across the globes. India is just a part of that. So taxpayers tries to, and there is a lot of negotiation, lot of brainstorming on that, and tax authorities always try to see those functions in a bigger lens and try to attribute more percentage to the Indian P so as to arrive at higher profits. Here, another important angle is what if at global level the company is into losses. So this is a very kind of a very typical situation, a very interesting situation we face. That foreign company at global level is incurring losses. How do you attribute to the P? So again, this is a very hot topic. Lot of case laws around this. So earlier there was a decision of Delhi High Court in the case of Nokia, which held that if there is a losses at global level, then there cannot be any further attribution. But Delhi High Court three-member bench in the case of Hyatt Hotels has recently revisited that decision, and they have said it is very contextual, and it is not necessary that if you are earning losses at global level, then P cannot have profits. Please, then it basically goes on the concept that P is a separate person. Allocate, and determine the functions-based income of that P on a separate basis, and then calculate its income. Also, CBDT has brought out a attribution report for taxation of Ps, where it lays down that in those cases, 2% 2% of the revenue which you are earning from India will be treated as a taxable income. But that report is just was just released for public consultation and has not been enacted as a law. So I'm sure you would have got a broad idea about how the business income is taxed under the treaty, and clearly attribution of income to the P is not walk of the cake. Rather, it is something which needs to be thought through. So we discussed, not going to spend much of the time on this. Fixed place PE, there are certain conditions. One is place of business disposal in India. If the answer is yes, then you check whether you are carrying on any business activities. Again, if the answer is yes, you check the degree of permanence kind of threshold. And if the answer is yes to this as well, then only you have a PE. If the answer to any of these questions is no, then you do not have any PE in India. So these are the three key tests we usually say fixed place PE tests. These are the three tests one need to satisfy in order to constitute fixed place PE. Then comes agency P. We discussed if a agency there is a, when agency P, if there is an independent agent, answer is yes, there is no P. Only if there is a dependent agent and he habitually exercises authority to conclude contracts, then yes, then there is going to be a P. Coming to service fee, for service fee, again we discussed if the foreign company is sending its employees personnel for visit in India, and they are providing relevant services, and the number of days exceed the threshold. In those cases, the PE would be said to be satisfied. Moving ahead, this was on business income. Then moving ahead, very briefly discussing about articles on dividend, interest, royalty, and FTAs. Practically, these are the articles where we see lot of traction, lot of taxpayers are interested in these articles because taxpayers tend to avoid the situation of P, but the way these articles are worded, they usually get fallen upon within the net of these articles. So dividend is whenever a foreign shareholder is earning income on dividend from shares of Indian company or vice versa. Here an important angle is the rate of tax in dividend in treaty is usually lower than what is there in the domestic law. Again, dividend article itself brings in the concept of beneficial ownership, which is a substance over form concept, and again a very tricky area where taxpayers do feel the heat, and tax authorities um, try to challenge the taxpayers on this area. Same is with interest. Again, beneficial ownership relevant for interest. And royalty FTS, again, a very talk of the town when it comes to international taxation, because whenever there is involvement of any software, then comes the talk of royalty. Similarly, involvement of any sort of services, whether managerial, technical, consultancy, there comes the talk of the FTS. And these royalty FTS, the way they are worded in treaty and the way they are worded in act, they are very different. The definition of royalty under the act is very wide, and whereas under the treaty it is still narrower, especially of royalty. For FTS, it depends on treaty to treaty cases, and there has been a lot of developments uh, in 2020 in the context of royalty. Supreme Court came with a very important decision in the case of engineering analysis, where it put to rest lot of litigation around software royalty. So that's a very important decision and plays down a lot of important principles. In what cases the license fees to use the software will be or will not be subjected to royalty tax. Moving ahead, Article 13 is usually on capital gains. These article numbers are can vary on treaty to treaty cases. Here we have mentioned the article numbers as per the model conventions. So in Article 13 of treaty, capital gains is there, and based on the nature of property, the right of taxation is given. So if it is a case of sale of immovable property, then the country where that property is situated, that country gets right to taxation. If it is the case of sale of shares, and the company of whose shares are sold, and that company by itself derives more than 50% of its value from the immovable property, then again the country where that such immovable property is situated. Apart from this, if there is case of any other shares, then usually the country in which the company whose shares are transferred is the resident. So if a Mauritius company is selling shares in Indian company, then it will be taxed in India. And in any other situation, for example debentures, then it says this example, it will be taxed in the hands of the transferor, that is in my example it will be Mauritius. So as you can see, these articles do not bring within their ambit the indirect transfer provisions. Those are there in the domestic tax law, but do not find in the treaty, and that again has been a point of debate between tax authority and taxpayers. So here I've just brought down the key changes in Mauritius and Singapore treaty. These are the countries from where a lot of foreign direct investment comes to India. So earlier, when any Mauritius or Singapore company selling shares of India, those were not subjected to capital gains were not subjected to tax in India. Then around 2017, there was amendment based on post which it was said that earlier shares will be grandfathered, but any shares acquired post April 17 will be taxed in India. Though two years cooling period was given, where the taxation was reduced to 50%. So, but yes, after 1st April 17, those capital gain will be taxed in India. So that what came in these two treaties, and it created a lot of buzz around the FDI and foreign investment players. So, so this was broadly on key. This was broadly on key principles on on tax treaties, key articles of tax treaties. So next, moving on to the basics around transfer pricing. So again, a very interesting subject. A lot of economics, lot of arithmetics, lot of logics involved. So how this exact process runs. So if we see, there are a lot of steps involved, and each of these steps come with detailed analysis. So first and foremost is a functional analysis. One needs to analyze what sort of functions is the particular particular entity performing. So here we typically tend to do a lot of interviews with the respective business units heads of the companies, understand the nitty gritties in terms of division of roles and responsibilities between that company and their foreign counterparts. So to understand actually who is doing the business, who is taking the decisions, who is actually reviewing, who is the reviewer, who is the maker, who is the checker. So we try to analyze the functional profile of the entity. Then once the functional analysis is done, then we do the characterization. Okay, now based on these functionals, whether it is a limited risk entity or it's a full-fledged risk entity, on this basis we decide actually what is the characterization for transfer pricing purpose of this party. Then we select the tested party. Tested party is on who is the tested party, who is the benchmark for you, against whom you should test yourself. So that is a tested party. In some cases, it's a related party. In some cases, it's an unrelated party on the case-to-case basis. Then comes comparability analysis. We compare the margin in our case versus that tested party, and here comes lot of work in terms of we use a lot of softwares, lot of market information. We extract a lot of publicly available financial statements, and try to find the correct comparables based on the same functional characterization, and once those comparables are found, then we do their margin, we check their margin and compare that with our margin, and see whether our margin is within the range of arm's length price or not. So all so I'm sure you would understand all of these steps by itself. They are very typical, and they comes with lot of analysis here. And then for this comparable analysis, we have a lot of methods. We have a lot of method which we will discuss in the next slides on how to compare, on what basis you should do the comparable analysis, and then you arrive at the arm's length price. So, linking this with the our earlier discussion on functional profile. So, as you can see, we discussed earlier that if a company wants to set up its manufacturing facility, so it would have a lot of options, whether it wants to have a toll manufacturer or a contract manufacturer or a licensed manufacturer or a full-fledged manufacturer. So all these manufacturers, as you will see on this axis, on the left, on the y-axis, we have functional assets and risk profile. On the x-axis, we have rewards or profit. So so with each type of manufacturer, the FAR changes. We usually call it as FAR on the y-axis, and so the consequent profits or rewards also change. The more far you perform, the more functions you are performing, the more should be your rewards or profits. So, to give a brief context, full-fledged manufacturer is one who owns own intangibles, sales to third party, own residual profit or losses. A full-fledged entrepreneurial entity. Licensed manufacturer is one who does not have any own intangibles. Using the intangibles of the group, he is doing the manufacturing process and selling to third party. Again, all profits belongs to it, but yes, it is paying some royalty to its group. Then comes contract manufacturer. Here, they are earning assured margin. They are just earning assured margin. Any windfall gain or loss belongs to its group, associated enterprise. Toll manufacturer is just similar to a job worker. They are not even purchasing the raw material. They just have their manufacturing facility. Similarly, another distribution, going back and discussing on this far for a distributor function. Like we discussed, there can be different types of distributor, or limited trust distributor, normal distributor, or super distributor. These are three categories which actually take the title and goods and sell on their own account. Then two other categories are agents or market support companies. They do not take title; they are just their service model. So similarly, like other example here also, as you increase your functional asset and risk profile, your rewards or profits also increase. So, like we discussed, super distributor is one who is creating markets on its own account. Whereas under the normal distributor, they are again remunerated on gross margin only. They get lot of assistance from their foreign AEs. Then obviously as we move down, limited risk distributor again, they do not undertake that much decision making. They do not undertake that much risks. They are just asked to act based on what their foreign counterparts ask. So this is how it runs. An important principle I want to discuss here is that then these foreign companies running these operations in India, whether it is manufacturing or it is marketing, they might also have a permanent establishment. So if there is a distributor, a foreign company who is there is a distributor or say sales agent, the fourth case, he is negotiating and concluding contracts on behalf of the foreign company. So that case falls within the ambit of agency P. So in this situation, they might constitute P. So now there comes a problem. If you are constituting a PE, then all the problems, all the compliances, tax liability for foreign company also comes. So to this rescue, there is an important decision of Supreme Court in the case of Morgan Stanley, a very celebrated decision in 2006. Morgan Stanley lays down the principle that if the Indian P, even if there is a P, if that is suitably compensated as per arm's length, based on all factoring all the functional assets and risk profile, if it is being compensated on that for that far already, then you need not attribute any additional income. So this brings a important room. This brings a very important headroom for these foreign multinational groups. That okay, they can avoid the any additional taxation. Only thing they need to be ensure of is that they are compensating all the functional asset risk in their for taxation under transfer pricing. So here your documentation becomes very important, that whatever functions your Indian company is actually carrying out, those needs to be appropriately captured in the documentation. So if some functions are not captured in the documentation and as per tax authority you are still carrying them out, then that Morgan Stanley decision would not be squarely applicable. And for those additional functions, you would be asked to pay additional taxes. Then moving ahead, these are the certain methods that are prescribed under the Indian tax laws for doing the transfer pricing calculations, for the comparability analysis and arm's length price calculation. So, so all these are case to case basis based on how I am operating my business in what market I'm operating, a person chooses the method, and you arrive at the most appropriate method uh, for arriving at the calculation. For example, comparable uncontrolled price. So if I am entering into a transaction and I can find out similar transaction, I am say I'm selling goods to my associated enterprise. I'm selling a particular, say I'm selling shoes to my associated enterprise. Then and these are and under the trading model, and I can see that there are numerous players in the market selling same category of shoes. I can find out the comparable price under uncontrolled circumstance. What is the price that the my counterparts are at which they are charging? Then comes resale price method. Usually, in the case of trading, where the associate enterprise is just doing resale, then what sort of resale margin it should earn? Then comes cost plus method, usually used in the case of back offices, where Indian companies are purely working for the foreign company. Then we usually say, okay, what costs you are incurring for entering these services, and then we we inflate it with certain profit margin, that this is the minimum margin you should be earning. Then that cost plus basis becomes the sale price, the price at which you should earn your revenue. Then come profit split method. Many a times the functions are so intrinsic. So two countries, say India and USA, the companies in India and companies in USA are working so cohesively that it is not possible to segregate it on a transaction to transaction basis. Then at a group level, we arrive at a total profit number, and split at the profit level among the various functions. Next comes transactional net margin method. This is the method which is used very commonly, TNMM we usually call it. So at a transaction level, we arrive at a margin. What margin under arm's length basis you should earn, and on that margin we apply the method, whether it should be cost plus or what method. Then, if none of the other these methods work, then we arrive at the other method. Say, if there is a sale of shares, and then those are backed up by the valuation report, or there is just a reimbursement of expenses. Again, this is a pure case of reimbursement, no margin required. Then all this come under the category of other method. So before going into next step, so we discussed about on transfer pricing, we discussed about the functional asset risk profile and how it impacts the profit margin. Then the interplay between permanent establishment and transfer pricing, and then these sorts of methods. And another important aspect here would be that Indian government, to minimize the litigation, they have come out with a safe harbor rules. So under safe harbor rules, if you are earning, so they have prescribed in certain situations certain margin what the Indian business should earn. So if at a part in those, if you fall in that category and you are earning those margins, then you should not be contested. There should not be any questioning from tax authority. It is to minimize the litigation. Only thing, you need to apply for that safe harbor and run through certain procedure. Once you do that, then you would be once you do that, then yeah, there won't be any case of litigation if you are falling within that category. Sorry. So next, moving on to a very interesting concept of place of effective management. So this is the concept we discussed initially while talking about residency. So so it is a very important concept for foreign companies which are operating in India. And clearly, no company wants it to be treated as resident of the other country. Usually, there is no such benefit. So, and that's where the principles are very much relevant. So, as we discussed earlier, as per Indian tax law, a company is treated as tax resident in India if either it is incorporated in India, that's a plain vanilla case. If you are an Indian incorporated company, then you are tax resident of India, or your place of effective management is in India. So the second one is the case which we are going to discuss. So if you are a foreign company and your POEM is in India, then you are treated as resident of India. And what is a POEM? POEM is defined to mean a place where key management and commercial decisions that are necessary for the conduct of business of an entity as a whole are in substance made. So each of these phrases are very critical to be understood. What is key? So if I place some, let me just, so if I place some impact emphasis on this word key, what is the key? What is management and commercial decisions? What is the meaning of decisions which are necessary for the conduct of business? Then entity as a whole. So not particular function, but you have to see entity as a whole. And lastly, in substance, you not need not see the what is in form, rather what is in substance. So what is the objective of bringing this law? Objective is to deal with overseas company which are controlled from India remotely. And so we have many cases where Indian operated structures, the key managerial persons stay in India, whereas their businesses are situated outside India. They are registered outside India. So that is the whole objective of bringing those companies also within the global taxation in India. So like we discussed, we need to see the decision making. What are the key decisions? What you mean key is based on case to case. If I am a investment company, for me key decisions would be uh, buying and selling of shares. So decisions related to buying and selling of shares might be my key operations would be seen here. Again, you don't need not see need to see the day-to-day business operations, day-to-day decisions. You need to see the management and commercial decisions. Actually, making the key investment decision. You need not decide poem based on some regular day-to-day run-of-the-mill decisions. For example, you can give for example whether who will be the authority for administrative functions, or the administrative or general administrative function. Those are not relevant here. Then you have to see the necessity of this business, of these decisions in the business, whether they are necessary for the conduct of business, the conduct of business as a whole. Then you have to see persuasiveness of those decisions on the bearing on the decisions on the business. And finally, in substance, you need not restrict your analysis based on what is in, say for example, the directors are taking all the decisions before the board meeting, and finally the board meeting is taking place outside India just as a rubber stamp. So that should not decide the poem. Actually, the place where the decisions are taken, that is relevant. And for this, CBDT has brought detailed guidelines on poem, on how you will determine the poem of any company in India. So they have brought down, you need to decide whether you are doing any active business in India, or just a passive business in India. Based on that, you decide the threshold. And they have also discussed um, on various aspects like what do you on various aspects like what if certain meetings are taken place outside India, certain meetings take place in India. Then they have and they have guided that you should go by the majority. How much so if the majority, more than 50% of the meetings are in India, then you should deem that the place of effective management is in India. So these are the few principles where where the CBDT has laid down the context of how poem is decided. So once you decide where the poem is, if it is in India, then you will be taxed just like any other Indian company, and you will be required to prepare all your books of accounts. Your global income will be taxed in India, but yes, I can tell you, while you are treated as resident for Indian domestic tax law purposes, there are a lot of practical challenges in terms of setting off losses, in terms of depreciation, in terms of difference in accounting principles among various countries, availability of tax treaty, foreign tax credit, etc., etc. So, so that's all from my side for today. So these are the so happy to take any questions. Thank you.
Thank you. Thank you so much, Nishant, for such valuable insights. It's really informative. So now we are moving to our Q&A session. There are certain questions has been asked by the participants. So we'll be taking. Uh,
Sure.
Nishan, one of the question is, how can businesses mitigate the risk of creating a permanent establishment in foreign jurisdictions? Can you please share your insights on this?
Sure. So a very valid question, and uh, usually you need to be cognizant of what sort of activities you are doing. You need to map it along with the permanent establishment laws. So, for example, if you are sending a employee, foreign companies sending their employees in India for carrying out the work, you need to see what sort of work they are doing, whether it constitutes the services from foreign company in India or not. Accordingly, you can arrive at other methods, for example, shifting the employment of that employee by itself, seconding that employee to the foreign, to its Indian company, to its Indian counterpart. In that manner, you can with the shifting of employment, then and yes, you have to ensure that there is no that is not there only in papers. Actually, that employee should be working under control and supervision of the Indian company. So with this, you can once you have you take tick all the parameters of secondment, then yes, you can. This can be an example where you can avoid mitigate the exposure of the P. And very important aspect of dealing with P is on the documentation. Many a times we see in our practical scenario when a transaction is entered, usually after 1 year we file our tax return. Thereafter, after 24 months, if it is not a case of not transfer pricing, tax authority give their order. So it's already 3 years have already passed by, and by that time the time kind of questioning that tax authorities ask, we are the taxpayers are usually not in position to answer them, because for the very many reasons, like they did not maintain proper documentation, or the relevant people in their businesses have already left the organization who were actually in the control of email or those transactions. So PE, determination of PE and mitigation of PE is by and large, lot of things depend upon your documentation, what functions you are actually performing. And if you believe that you are in the ambit of PE, there is no harm in deeming yourself as having a PE and preparing the books and yourself admitting that you have a PE and offering your income to tax accordingly. Many a times we have seen, because please appreciate, in the case of PE, it is taxed on net basis at the rate of 35%. And if you are not a PE, you are earning income by way of royalty or FTS. Most of the TTS, it is 10% on gross basis. So many a times, even we have seen the taxable income under PE is lesser than the income which is in the case of non-PE. So so you need to factor all these cases and decide and accordingly take a decision on P.
Thanks, Nishan. Noted. Next question is, how will technology impact international tax compliance and administration? Any insights on this?
So yeah, absolutely. So technology, the way technology is evolving, undoubtedly it is impacting all the areas of businesses, and taxes not an exception. So like we see today, let's start with the government itself. The way our administration works, our government works, by themselves, they have introduced so much artificial intelligence in their own systems that today we file our return. Even let's we file our return, then by itself it gets processed by a lot of logics drawn in the computer. They have their own way of detecting the skeptical cases. Based on that, they themselves, based on that computer software itself and artificial intelligence, the cases get picked up and selected for the scrutiny. Another aspect is, I am making payment to a person and I am deducting the tax. There is a 26AS, a very so much a big comprehensive statement gets developed. As a foreign taxpayer, we have seen a lot of foreign country companies, they get impressed by the level of our 26 years. They themselves don't have so much information with their own records, and see the level of information which Indian government already have about them. And so this 26 years is another important example of how technology is used for collation of data, and then not to ignore how these are marrying. So if you have a income in 26 years, you are not reporting that income in income tax return, then your software of computer processing by itself, it detects that there is this difference, and it gives you an opportunity to give the reason. Similarly, if you have an income in 26 years and you are not filing your tax return, you get a notice that, see, you have an income on which TDS has been deducted, still you have not filed the return. So you get a proper notice. So, and this is one part, this is only income tax. Then we see GST. Even our income tax is speaking with the GST system. So again, it is all because of technology. I am reporting a revenue of X to GST authorities, and I am reporting revenue of Y to income tax authorities. I will get flagged off that there is a difference between these two systems, and this is purely driven automatically by these artificial intelligence and logics. When our government itself is putting so much efforts in the technology, invested so much in the technology, then it itself it by default, it forces the businesses to have that much robust system in their internal business. Our small businesses uses tele, it should marry with our tax returns with our 26 years. Similarly, our big businesses use SAP, Oracle. It should marry with all our tax filings. Our SAP Oracle should be robust enough to, at the time of transaction itself, there should be deduction of TDS at the relevant rate, and by the 7th of next month it is paid, because humanly it is not possible, and it is prone to so many differences, so many mistakes. And the type of compliances and the level of quality government is expecting from the taxpayers, the use of technology tools, we have so many vendors in the market, use of technology tools has become the need of the hour for any business to sustain and proceed with this.
Thank you, Nishant. Quite informative, I would say. So I guess our participants are more into P issue. So let's just one last question in respect of service fee. So the participant is asking, for example, there is a foreign expat is sent to Indian entity and appointed as an operational director in the Indian company and is responsible for strategic decisions of Indian entity. Can we consider it as service fee or any other fee?
Uh, Sorry, Tanya, can you please repeat the question?
Sure,
There was some
sure.
lag.
Yeah. So basically, the participant is asking there is a foreign expat sent to Indian entity and appointed as an operational director in the Indian company. And this person will be responsible for strategic decisions of Indian entity. So can we consider it as a service fee or any other fee?
Uh, what is he responsible for the Indian entity?
Strategic decisions of the Indian entity.
Strategic
Strategic
decision. Okay.
decisions.
So, absolutely. So, it becomes important to see whether this expatriate who has come to India has the employment been transferred? Has he been seconded to Indian company or not? Which usually, when the person of that senior level comes, usually they are seconded. So, so if he is seconded, he is working purely for Indian entity under the control and supervision of board of Indian company, only reporting to the board of Indian company, and all their secondment agreements are in place. He is not working as an employee of foreign company. uh, Keeping in mind all these judicial precedents and the mitigating factors that he should take care, then yes, he can avoid the exposure to PE. The PE exposure should be low in that case. But like I said, the in substance, it should be seen that yes, he is seconded. It should not be the case that he, even if he is seconded, he is still working for the foreign company, for the business of the foreign company. Because in today's world, it is very easy to work for foreign company, more than one company. So so if a US company employee comes to India on secondment, and earlier he used to work for another customer of that US employee, now even if he is on secondment, still that earlier customer reaches out to him for his earlier problems or for his new problems. He says, you already know me, why don't you answer these questions? So but here the problem comes. He is the Indian employee, he should strictly work for Indian company only. If he is working, if he continues to work on the for the customer of foreign company, then he is putting himself as well as that foreign company at risk. If this is the case, then then this work is also he should do under the supervision of the board of Indian company, and for this work, Indian company should be compensated for the services from the foreign company. So importance is on be clear on what functions you are performing. There should not be mixing of the functions of two companies that expat is doing.
Okay, noted. Thank you, Nishant. Actually, participants are keep on asking. If you allow just one more minute, so can we
Yeah,
take
sure.
the question? Yeah. So the participant is asking if a UAE free zone entity has an employee in India working remotely for such a UAE entity for more than 9 months, will it create a service fee?
So, so I think under UAE treaty there is a specific clause of service fee, and yes, it lays, and I think it lays on the threshold of 9 months only. So, plain vanilla answer to this question is yes, it should create a service fee. But yes, you should test actually what sort of services are being rendered, whether it is just a stewardship activities or whether it falls within the ambit of preparatory or auxiliary activities. That it is not a core business activity. So but yes, plain vanilla base on the prima facie, yes. If it is beyond 9 months, this is a service fee.
Okay, okay, Nishan. Thank you. Thank you so much. I think you have provided us with a lot to think about, and maybe participants will keep on asking questions. So you can write to Nishant separately and he'll provide the answer. So as we come to the close of this event, it is my privilege to extend a vote of thanks on behalf of the committee to all those who contributed to the success of this event. A heartfelt thank you to all the participants who have joined us today in the webinar. So once again, I would like to thank each and everyone and would look forward to seeing you all at our future events. Thank you, Nishant. Thank you all. Thank you so
Thank you, Tanya. Thank you, everyone, for having me here. Uh, Thank you so much. Thank you.
much. Thank you.
Thank you, everyone.